What's going on, guys? Marco Trades here. Today we're going to speak about my model that you saw in the first video. So let's just get straight into it. The main three components of my model are the 9:50 to 10:10 a.m. macro. This refers to time. The midnight and 8:30 opening prices. This refers to price. And the third thing is target selection, aka drawn liquidity. The estimated annotation time for these are about 2 minutes. So just really fast annotations, and you can already hunt for a setup with these three things. So now you just got to understand each component, right? This setup is really simple and mechanical, but you still got to understand what you're doing and how you're going to use all these three components because they are absolutely essential to one another. The first thing is the 9:50, the 10:10 a.m. macro. You just got to understand what's a macro and why a macro is important. So to make it real simple and brief, a macro is a 20-minute interval in a market where the price is going to spool higher or lower into liquidity pools or inefficiencies, right? Above or below the marketplace. This is really advantageous to know at what time the market is going to spool higher or lower. So what are ICT concepts all about? Time first, the macro, then price. We're going to go over this right now. Second thing is the midnight and 8:30 opening prices. You got to understand the concepts of premium and discount in the market. So premium and discount, to make it real simple as well, a premium is when the price is really overextended to the upside, aka the price is really expensive for the day. So smart money are going to look for shorts position only, while the retail are going to chase the price higher. A discount is basically the opposite. When the price is really cheap for the day, smart money are going to look for longs only, while retail are going to chase the price lower. So we want to go long in a discount and we want to go short in a premium. So what does that mean? We want to go long whenever the price is beneath both opening prices, and we want to go short whenever the price is above both opening prices, right? Time first, then price. Third thing is target selections, aka drawn liquidity. You just got to understand the importance of a drawn liquidity, right? A drawn liquidity is basically going to be our target. It is going to be our focus, right? So you're going to set this focus. It doesn't matter. You don't need a daily chart for this model. You don't need a weekly chart. You don't need the 1 hour charts. If you add these to the model, great. But I don't even use it myself. The drawn liquidity will be our target, our focus. We are going to set our eyes on that. For the second point here, understanding the difference between relative equal highs and lows versus a single swing high and a single swing low. So for my case, why do I love using, for example, relative equal highs over a single swing high? Well, it is simply because of high retail entry parties levels. In the eyes of retail traders, smooth areas or quote-unquote equal highs or equal lows are often seen as true levels of resistance or support in the market. They are going to trust these fake resistance and support areas and expect the price to bounce off of them to give them profitable runs. This is exactly where there is going to be the most liquidity, above and below these levels, because this is where the retail traders put their orders at, their stop losses and their breakout orders. So we, as smart money, see these levels as a high probability drawn liquidity. We are targeting these levels because we know that the algorithm will absolutely seek the liquidity above and below these lows. So essentially, any areas in the market where you see clean highs that haven't been taken out, or clean relative equal lows, for example, you know that you want to target that. You know that you want to use this as your drawn liquidity. So with that understanding, we only want to use two type of targets for this model: the London relative equal highs and the London relative equal lows, or the pre-market relative equal highs and the pre-market relative equal lows found post 7 o'clock in the morning. So now let's just jump into some examples real quick. The first example that we're going to look at is for the day of June 18, 2025. You want to annotate the macro first. I like to just use a regular rectangle labeled as a macro for visual clues. Then you want to annotate the two opening prices, the 8:30 open and the midnight open. Then you want to put your targets. So for this case, we had some pre-market relative equal lows here, engineered after 7 a.m. Notice how it's 7 a.m. here. So all of these lows are relative equal lows, right? And we have some relative equal highs as well, engineered at 7:45, which is still post 7 o'clock. All of these highs are relative equal highs. So now you just want to read price action. Where is the price located at 9:30? which is the opening bell. We are between these two liquidity pools, and we are also between the two opening prices. So you just want to wait for the price to make manipulation somewhere. For this case, the price starts pulling lower, going into a deep discount because we're beneath both opening prices and we swept these equal lows, right? The last target that is left is the buy side, and we're in a discount. Remember, we only want to buy in a discount. That meets all the criteria for a long. Now, next thing you want to see is the market giving clues that it wants to go higher. We use the first positive fair value gap as an inversion fair value gap. Notice how the price just grinded through this SIBI here, and we used it as inversion, creating a bullish order block at the high of it. Using this as a mean of entry, targeting the buy side. It's a setup which is a 1-to-5 risk reward ratio, yielding 55 handles, and as you can see, the price go much higher if you use standard deviation to the upside. For our second example, we are going to use the day of Tuesday, June 17, 2025. You want to annotate the macro, 950 to 1010, the two opening prices, and our targets. So in this case, I use the London relative equal highs, and we have some pre-market relative equal lows, sell side liquidity, right there. So now you just want to read price action. What did we do? 930 open, we expanded higher, swept the minor buy side. Notice how we fell short of the London highs here, and then the price quickly expanded lower into the sell side. At this point, because we swept the sell side, and because the price is in a deep discount, and because we left relative equal highs behind, you want to look for longs only. Then what happened next? We have higher displacement, and the price come back inside this BISI right there. Notice how the bodies respect that BISI here, and the wick do the damage. Then we expand higher above that SIBI, acting as inversion fair value gap, and we retrace back into the consequent encroachment of that inversion fair value gap here. Inside that buy side and balance sell side inefficiency, and inside that bullish order block, which are these three consecutive down close candle. So there is three confluence here to go long. That's your perfect entry. And then you aim for the London relative equal highs, and you want to take a partial above this high. We expand higher into the partial. The price retraced all the way back down to the first presented fair value gap. Notice how the candlestick bodies are closing in the upper half and the wicks are doing the damage. Then we quickly expand higher into the London equal highs. And for the third example, I invite you to click on this link that is going to direct you to my first video on my YouTube channel where I made $1,000 using this very exact model. So now that we went over the model and the very specific steps of it, let's actually go into the most important part of this lecture, which is knowing the three big skills that every trader must have. The first point is having an edge, a strategy, which just went over this. The second point is having risk management skills. And the third point is having the right approach or the right mindset to trading. If you want to make consistent money in the markets, you have to have the right psychology, the right mindset. So the first thing is having an edge strategy. This is the video that basically presented my edge in the market and what do I use in terms of strategy. As you can see, it's really simple and mechanical, but still, you still have to put the reps in. You can't expect to make money right after watching this video with this strategy, because the truth is, guys, it's going to require time for you to truly get it and for you to truly be comfortable with the strategy. So you just have to put the reps in. You have to put the time in and just be patient. It's going to happen for you. The second point is having risk management skills. Having risk management skills is being able to manage your risk properly on each trade, each week, each month, over and over again. And the third point is having the right approach, mindset to trading. Guys, this is what actually hold the first 2 points together. If you have these first two but you don't have the mindset, which was my problem for a long time, you're going to blow your accounts. And that's just the truth, right? You got to have these three skills. It's a non-negotiable, it's essential. So thank you for watching this video, guys, and I tried to explain my model in under 10 minutes. Hopefully you liked it, and thank you for watching. Be safe. Peace.